Well, good morning, everybody, or good afternoon, depending upon when you're watching this video. This is Tom Marshall, Virginia State Retirement Planning Advisors on Memorial Day weekend. Beautiful weekend here in Virginia. Hope you're enjoying yourself and getting out in this beautiful weather. But today I wanted to give everybody an update of what we're seeing in the stock market so folks can actually get a handle on what's going on and so on and so forth. The chart you see on the screen right now is a chart. It's a weekly chart of the S&P 500 index, and you can see this over on the left-hand side, S&P 500 index. W means it's a weekly chart. So this chart goes back to about October of 2018 through Friday, May 24th. And what's interesting is, as you can see from this chart, each line is a weekly tick of activity, if you will. So in late 2018, when there was talks of tax cuts, we had this run up, and then we had a correction of about 10% in January, February of 2018. Things stabilized for a little bit, and then we made slightly newer highs in the fall of 2018, and then the market just dropped like a rock, over 20% actually, in the end of 2018. And we had this tremendous rally off of this low in December of 2018 to where we are now. So key thing to notice here. Now, over the last 18 months, since January of 2018, January 15th of 2018, the S&P 500 index, the value was 2810.30. Now, we won't worry about how that's calculated and that sort of a thing. The point is, though, is that here we are almost 6 months later, and the value is almost identical, maybe 1 percentage point higher. So the key thing is, though everybody's talking about what a tremendous first quarter we had and this tremendous rally and that sort of a thing, which it is, the problem is if you are a buy and hold investor in the stock market, you have essentially seen no return on your investment in the last 18 months, and all you did see was a 20% decline in the stock market in the fourth quarter of 2018. So you had a lot of volatility, and you have no return to speak of. So before everybody, because you see the things on CNBC and other places about, what's the year-to-date returns of X, Y, and Z. Well, yeah, it's been great. The problem is you were starting at this low where you were down 20% if you were all in the stock market, and essentially you've made it all back. Good for you. So the problem is then it goes back to, where do you start counting? So the different managers that we use are looking at these different pieces and looking at valuations, and essentially, if you go take the more longer term approach, not the shorter term, what happened today or this week or that sort of thing, you'll see that essentially, unless we can break out soon to new all-time highs, this is setting up for one hellacious triple top in the stock market, and that's why you're seeing some of the more defensive plays right now going on in the stock market, or at least in the managers that we're using, because this is not indicative of a major rally blasting off. This is a topping process, and I'm going to show you some other things here in a minute. So again, for the last 18 months, if you're a buy and hold stock only investor, you're barely positive, and but you got to live with a nice 20% correction in the fourth quarter. So again, your last year-to-date numbers are fantastic, but your 18-month numbers are horrible. So it's those of you who've been with us a while know that in the fourth quarter of last year, October-ish, the managers just started throwing stuff out because they got concerned about the risk September and October, and started putting stuff into bonds and cash and things like that. So that's where we are right now. But if you look at this, essentially this red line is where we closed on Friday, and we were here in January of 18. We were here again in July of 18, dropped through it October of 18, and then got back through it again in March, and here we are just bouncing around again. So essentially 18 months of nothing. So again, it's all on how you measure these things. Longer term, though, what drives our managers are just various models that they use, but longer term pieces also drive it as well. Now, some of you have seen this chart before, and it's actually interesting. This is a chart of the percentage of American household equity holdings and subsequent stock market returns. So this goes from 1951 all the way over to a few weeks ago. The gray axis here is percentage of American household wealth allocated to the stock market. And these numbers come from the Federal Reserve, the U.S. Treasury Department. And then the right axis is future forward returns at that percentage. And so what this chart is telling us is that right now, this is the gray area, or the gray line, right now, the average American household has over 45% of their wealth allocated to the stock market, either through mutual funds or individual stocks, does not take into account bonds, cash, and home equity as far as this percentage. That would be the other 55%. Most of the other 55% not in the stock market is home equity and cash. So right now, over 45% of American household wealth is allocated to the stock market. The only time we've had a higher percentage allocated to the stock market was the dot-com craziness of 99 and 2000. Even in 2007, 2006, before we had the great financial crisis, we never got this high. But given where we are right now and this how this works, what we would expect, given how much allocation we have to the stock market right now historically, that we should only have about a 2% future 10-year average annual return if you buy and hold at these rates. So again, because almost everybody's in the pool, so to speak, just simple supply and demand, what this would tell us is historically, this level of ownership of the stock market correlates to a 2% average annual return over the next decade. So that's the gray. The orange is the actual. And this is where it gets interesting because the difference between the orange and the gray is really very minimal. They're very closely correlated. But there's always a 10-year lag because with the orange line, you actually have to buy on a certain date, and then you wait 10 years, and then you have a realized rate of return. So this 10-year number here, the orange, is essentially somebody who bought in May of 2009, and then they held it till now. And so they've realized about a 14 or 15% rate of return for doing that. But also back then, the average American household only had about 30% of their wealth allocated to the stock market. So again, the orange is actual. You put it in today and you wait 10 years. So over the next 10 years, this orange line will advance this way, and the gray will advance that way. So gray is what would you expect starting today, and then the orange tracks it because you actually have to hold it for 10 years before you have a realized rate of return. So what this would tell us is right now, this is not the time to be 100% invested in the stock market. It's just not. And so something to be mindful of, and this is one of the things that our managers are looking at, both in the prudent momentum and the Tredegar tactical portfolios. Another thing to look at then is this is actually the Buffett indicator. Warren Buffett did not create this, but he used it a lot. Actually, this indicator has been around before Warren Buffett was born. And essentially, it's a fraction. And the idea behind this is to look at the total value of the stock market, and that's the numerator of this equation. And this chart goes from 1950 through a few weeks ago. So numerator is corporate equities, all publicly traded corporate equities. And again, this is from the Federal Reserve. And the denominator is the nominal quarterly GDP. So essentially what you're looking at here is what percentage to purchase the stock market is GDP, because obviously the stock market should be a reflection of the economy. So if the economy is growing, the stock market should be growing. But if you pay too much for the stock market in relationship to the engine that drives it, which is the economy, it could be a problem. So what it's telling us, though, is that right now, where we are today, that the stock market is valued at 140% of our GDP of our country. The only time we've had a higher price that we paid, again, this is if I'm trying to buy the stock market, what percentage to buy the stock market is the GDP. The only time we've actually paid higher, a percentage of GDP, was 1999-2000 time period. So again, just from the idea of the price that you pay dictates your future returns, this is not a time period to get all in, just because of how these things are going. You can also take that last chart and project out what your future returns are. So this is market cap to GDP, and it's kind of reversed to give you an inverse look. But there's an 84% negative correlation between the Buffett yardstick, or the market cap to GDP indicator, and future forward 10-year returns. So what it is telling us, though, is that right now, this is a chart again from 1950 through a few weeks ago. And right now, based on the market cap to GDP ratio, you would expect a future forward 10-year return of negative, slightly -1. So if you buy and hold stocks, a future negative return of -1 or 2. The only time we've been below the zero line was last summer, and then 99-2000. So again, this is indicative of overpaying for the stock market in relationship to the GDP that powers the stock market. And as you can see, there's a pretty tight correlation. The orange is the forecast, and the blue is the actual. So this is the forecast, the orange, and then the blue always lags 10 years because, again, what has to happen is you had to put your money in the stock market in May of 2009, and then you hold it until May of 2019, and now you have a realized average annual return of about 15%. Again, that was the time to be all in. This is not the time to be all in. When you're below the zero line, this is when you need to be harvesting gains in your portfolios, because this has never turned out well historically. No matter what the buy and hold folks who want to keep you in the market want to have you expect. This is another chart that we look at as well. This is a newer chart for some folks that haven't seen this before from us, but this is the Dow Jones Industrials valuation. And instead of looking at price, the market cap to GDP, this is looking at median enterprise value to revenues. So what is enterprise value? Enterprise value is the total value if you wanted to buy that company and take it private. So because so many companies are doing buybacks and using debt to purchase shares, you actually, if I was going to buy, let's pick a company, let's say General Electric. I wouldn't want to buy it, but it is what it is. I would have to buy and take it private. What I would have to do is I would have to buy it. I would take pay for all the outstanding shares of the company, but then I would also have to pay for all of its debt. So enterprise value is all the outstanding stock and all the debt. And what this does is it looks at median enterprise value of all the Dow Jones Industrial Companies from 1984 through a week or two ago, and you look at that as a ratio of enterprise value to revenues. And what we're finding is right now is that the Dow Jones Industrial Average trades, the median valuation is 3.5 times revenue to the median value, enterprise value. So essentially, when you add up all the stock, all the debt of all the companies of the Dow Jones Industrial Average, the median company or companies, there's two of them actually, trade at 3.5 times revenue. That is obscene. That is extremely overpriced. We've never paid this much for these companies. The only time we've got even close to that was 99 and 2000, but you see right now is that we're actually significantly higher. So we're actually paying more now than we've ever have in history for these companies as a ratio of enterprise value to revenues. So again, not a time to be going all in. This is actually buying at nosebleed prices. Something else that's out there that something that we look at, this is actually the global recession probability model. This is from a group called Ned Davis Research. You can find them at ndr.com. And this is a chart from 1971 all the way through a few weeks ago. And actually 1970. And so what it does, though, is what Ned Davis Research is that they are an unbiased research firm, and they just aggregate data. When different countries release data like producer pricing index, purchasing manager index, all these other different index and pieces that you read about, that everybody wonders, well, how does that tie together? What Ned Davis Research has done is they aggregate that data into a model, and just looking to see historically how does it tie to future returns, and not really future returns, but more of probability of recession in this model. So what it's telling us, though, is that given all the weak data coming out of China and Europe, and what looks like starting to be weak data out of America this past week, with different things going lower readings than people were expecting, the current valuation, the current number of this probability recession model is at 96 and change, 97 and change right here. And you'll see these different, it's kind of a wavy chart, and just shows you that when you're in the gray area historically, you wind up in recession. And sometimes it works, sometimes it doesn't, but it has a very strong correlation. So what they show us is here, whenever this model is above 70, we hit recession 91.72% of the time, and only 8.28% of the time do we not have a recession. So if we're above 70 on this model, 9 out of 10 times we have a recession. 1 out of 10 times, less than 1 out of 10 times, we don't have a recession. Right now, this model is telling us that we are at 97 on this model. And this is one of those things where the higher the model gets is not a good thing. We want it to be as low as possible. So what this is telling us here is that it's an extreme reading, and we should be more concerned that we're leaning towards the 9 out of 10 times as opposed to the 1 out of 10 times. So what this model is saying is that 90% of the time when you have the different readings, economic readings from around the world coming in the way we do, it has led to recession 9 out of 10 times. So again, not a time period, or a time place where you want to be all in the stock market. Just not going to be there. It's just not smart to do that. You want to be when the numbers are lower. That usually means that the stock market has fallen dramatically and there's panic in the streets. And just when you don't want to buy is probably the time to buy. But again, this is telling us this is an extreme reading. Every time we've got above 90, as far as I can see on this chart, it's wound up in a gray area. So we've had a recession. So again, another reason to be very cautious out there. This is another chart. This is actually the Shiller PE ratio chart. Some of you have seen this is actually updated as of Friday with Friday's data. And this chart goes from 1880 through Friday. And the Shiller PE ratio, the Shiller price to earnings ratio, Dr. Shiller, as you may know, won the Nobel Prize in economics about a decade or so ago for his work in this area. And the idea being is that you should pay more for companies when the economy is expanding, and you should pay less when the economy is contracting. There's more to it than that. Obviously, you don't win a Nobel Prize for that, but that's the idea in a nutshell. What it's telling us, though, is that right now the price to earnings ratio on the Shiller model is 29.1. Again, it is what it is. You look at it in relationship to other things. The only time we've had a higher Shiller PE ratio number, 99-2000, and then 1929. We didn't even get this high during 2007 before the correction, great financial crisis, and then this past summer as well. So again, this is rarefied air. This is not where you want to be all in. This is a time period where you got to be very careful of the price you're paying for different investments. Is it time to harvest gains? Speaking of other ratios, this is the S&P 500 price to sales ratio. And so, as you may know, this ratio is interesting. It actually is a different take on what you're paying for a company, but sometimes firms can play games with their earnings. They back out stock option compensation and that sort of a thing, and that's their stated versus adjusted and so on and so forth as far as earnings. But revenue is revenue, and that's what the sales are. So sales, you're just looking at the revenue. This is before they take any deductions. I'm just looking at the price that I'm paying for these companies in relationship to the revenue that they generate. So what this ratio does, it goes from 2002 over here through Friday. And essentially what they do is they take all the revenue of all the companies in the S&P 500. They add it all together, so it's trillions of dollars. And then they divide by the market cap, or the stock outstanding, if you will. And you get a number. So right now the number is $2.10. And so what this tells us, though, is that to buy $1 of revenue in the S&P 500, it takes $2.10. Historically, anything over $2 is considered extremely overvalued. The only time we have paid more than $2 was last summer. And then you go back here, 1999, 1987, so on. What's interesting is this ratio you'll see from the bottom of 2009 until now has pretty much gone up. And it's not supposed to do that. See, again, what this means is essentially is that when this ratio is going up, it means revenues are going up 5%, but people are willing to pay 10%, 15, 20% more. And so they're willing to pay more than what the revenue is growing. And it's really a function of the Federal Reserve driving people in the stock market who used to get 5 or 6% on CDs and were comfortable with that. So they're driving them into the stock market looking for yield. So this is a very abnormal look to this curve. And anything over 2 is considered extremely overvalued. What this curve should look like, or this line should look like, is here. This is from 2004 through 2008 before the great financial crisis. Essentially what you see is the line is flat. Well, the stock market was booming from 2004 till 2007, but at that point in time, revenue's up 5%, people are only willing to pay 5% more. Revenue's up 10%, people are only willing to pay 10% more. Unfortunately, due to all the financial engineering that the ultra-low interest rates have caused, you see this idea where essentially a company's revenue is only up 5%, but hey, I'm willing to pay up to 10% more for that share because what else am I going to do? So historically, the problem is anything over $2 is extremely overvalued. We've only been here a couple of times. Last summer, 1999, 1987, 1973. So these are not values where the market typically blasts off. This is where we typically go sideways and we start to roll over time. From a asset allocation standpoint. The last time we were at this price to sales ratio or had one that was over 2 was 1999. And this is actually a chart from, I believe, Morningstar, and it just shows us what does the next 15 years look like, or could it look like? This is the last time we were here, and what they're trying to show us is that 15 years after it happened last time, we actually had only 4 bad years, 2001 and 02 and 2008. So 11 good years, 4 bad years. So from a very kind of top level of thinking, you would say, well, I should be okay. 11 positive years, 4 bad years, I should have a great return. Well, the problem is when you overpay so much, and when you do have a correction, you have a serious correction. I mean, not like what we saw in the fourth quarter. That was just a blip. When we actually have an end of a business cycle type of a correction, they get much deeper. And so because you overpaid so much in 99, when you do have corrections, they're pretty deep. And when you compound this all the way through over a 15-year period, the average annual return is only 3.25%. So let me state that again so you can understand. So buying at these levels, the last time we were above $2 on the price to sales ratio chart, which was back here, the next 15-year rate of return, because you have corrections and the corrections get pretty deep, 3.25% return. So again, this is a time not to be uber crazy with allocations, to get more defensive. And that's why you're seeing some of the managers getting even more defensive, things getting thrown out of portfolios, and now they're shopping for yield. We'll talk more about that here in a second as well. This is still out there too. This is just, let's look at interest rates now. So this is a chart from Bill Hester, who I believe still works for Morningstar, but it's a chart that goes from 1965 through a couple weeks ago, and he asked a very important question not too long ago. He said, when before in the past have we had new all-time highs for the S&P 500, which we did in September, October time period, and also not too recently, not too short time ago either. And the Fed has been raising interest rates at least 2 times in a row. So the key thing here is that as long as the Fed is in a raising cycle, it still counts. The only thing that would negate this is that the Federal Reserve actually started to lower rates. So even if they stay flat, they have been raising, and that's what counts. But you'll see here is that since 1965, we've only had 8 times when we've had new all-time highs for the stock market, and the Federal Reserve is in a rising environment and has raised rates at least 2 times in a row. They've raised rates 10 times since they started this whole thing. So here we are. But you'll notice is that every time, except for one, we've had major corrections in the not too distant future. And this is not like what we saw in the fourth quarter. This is serious end of business cycle stuff, because that's why the Fed does what it does. It raises interest rates trying to cool off inflation. And usually they don't really know what they're doing. Let's be very honest, half the time. But what they do is they raise it too much or too little, and then the business cycle ends despite what they do. And so the values have to readjust. So if I buy a company today and it's growing at 20% and that company hits a recession, I'm not going to pay, even if their growth drops to 10%, I'm not willing to pay as much for it as I was before. So the prices have to adjust. So again, just looking at interest rates, what this is telling us is that unfortunately, this is just a very serious problem with the stock market and interest rates. And so we got to be very mindful of this, because when the Federal Reserve is raising interest rates and you have new all-time highs, that's a classic signal of the end of the business cycle when you have the adjustment in valuations. We still have this outstanding as well. Some of you have seen this. This is kind of funny, I guess. It's called the toilet paper indicator. And the toilet paper indicator looks at Procter & Gamble and old PG right here in this column. And it compares the value of Procter & Gamble versus an index called XLY. And XLY is an index of companies that are in consumer discretionary things. So let's look at it from a broad perspective. Procter & Gamble is a company that makes toilet paper and soap. You're going to buy things from Procter & Gamble whether there's a recession or not. And so that's called a necessity. It's called a staple. But Procter & Gamble usually doesn't grow that fast because how much toilet paper do you actually need, type of a thing. And so then so in a major bull market, Procter & Gamble is always going to lag because people buy it for the dividend. But you compare the return of Procter & Gamble to XLY, which has all the companies which are consumer discretionary. So this would be restaurants, clothing, automobiles, things that you may buy, but you don't have to buy it. It's if you have the money, you'll buy it. If you don't, you'll not buy. And so again, you're comparing needs versus wants. So you need toilet paper. You may want to get a new car, but you don't need it right now. And what you do though, with this analysis is you compare the rate of change. That's what ROC stands for. So you compare the Procter & Gamble rate of change versus the XLY. And normally Procter & Gamble lags significantly because, again, how much toilet paper do you need? But where you start getting nervous is that they compare this every month and then they look back over the last 3 months. So every month they look at it and they look back over the last 3 months. And if Procter & Gamble has outperformed the stock market by at least 20%, that's a problem. Because that means that essentially the portfolio managers who own billions of dollars, trillions of dollars of these different stocks have decided that they would rather own toilet paper than things that are growing quickly. And so in the last 30 years, we've only seen this trigger a couple of times. We saw it down here at the bottom in September of '99, where Procter & Gamble outperformed the XLY index by over 20%. But then you see it start happening kind of quickly. September of 2000, October, November of 2000, August of 01, September of 01, October of 01, September of 02. So this is all that decline from 2000 through 2002. We had 3 years of the stock market losing money. And so the portfolio managers who have to be fully invested essentially are saying, I would rather own toilet paper during a recessionary time period, a potential recessionary time period, versus automobile companies and restaurant companies and that sort of a thing. So it's essentially what it's saying is what you're seeing people who control massive amounts of stock are putting their bets and forcing certain stocks to go down and certain stocks to go up by their buying and selling. That billions of dollars of stock of people who trade stock would rather own the toilet paper than the growing consumer discretionary things. And so we saw this during 2000 through 2002. And interestingly enough, it stops for 5 years. You don't see this happen again. And so between September of 02 through September of 07, stock market's growing. There's growth in the economy. The XLY index of companies is significantly outperforming toilet paper. And so you don't see this get triggered. But all of a sudden, in September of 07, really before the financial crisis started to get going, you saw the portfolio manager saying, I'd rather own toilet paper. And then it happens again in November. And then we really get going in October of 08 and November of 08. So these 4 lines from September of 07 through November of 08 are showing us that, again, this triggers again. The portfolio managers would rather own toilet paper than consumer discretionary type of companies. And it gives us an early warning that the smart money is being very careful, and maybe we should be watching that as well. But this was an early indicator that the great financial crisis was going to happen and that there was going to be a problem, and perhaps we should be getting out of stocks a little bit too. Well, that's fine and dandy. So it stops in November of 08, at least the last time period before the most recent. But then 10 years difference from November of 08 through November of 18, 10 years, and you've no difference at that point in time. It hasn't been triggered. The consumer discretionary companies were outperforming Procter and Gamble because the economy was growing and the portfolio managers would rather own the growth companies than toilet paper. And now all of a sudden, November of 18, for the first time in 10 years, toilet paper is outperforming the XLY index by over 20%. And so again, it's an early warning indicator that typically precedes major times of turbulence and problems. When the portfolio managers want to own toilet paper, they're selling other things to buy it, and it forces demand for Procter & Gamble to go up and lack of demand for the other companies. So it's a warning. And interesting enough, even though we've had this tremendous rally off of those lows in December, Procter & Gamble was at new all-time highs last week or the week before. So even though we've had this rally, what it means then is that the portfolio managers are still not comfortable with parting with their toilet paper. So when we see Procter & Gamble start going down, that's when you see is a kind of an indicator that maybe the worst is behind us. As long as Procter & Gamble is bouncing around new all-time highs, there is no reason to do anything at this point in time from this indicator. But again, it's one of several things that we look at, and the point is that people that manage billions and trillions of dollars are worried. They're more comfortable owning things that they know people are going to buy no matter what, versus are they going to go out to dinner on Friday night because of what's going on. So you get the point. Again, this doesn't happen very often, and when it does happen, you have to be very concerned. So it's a problem. Next piece, this has been updated as well. I had a client that came into our office back, I guess it was January or February, and was asking, came in and said, put me all back in the stock market. I think the worst is behind us. And so my question to him was, well, we certainly can do that, but why do you think so? And so his remark back was, well, hey, heck, unemployment's below 5%. Economy's humming along. We should be fine. So I want to catch the next leg. Well, that caused us to do some research. And so this is a chart from the Federal Reserve of Dallas. And this is a chart from 1990 over here through a couple weeks ago. And what you'll notice on this chart is that wherever it's red, that's when unemployment is below 5%. Okay, that's great. Means the economy is humming along, doing nicely. But interestingly enough, the black line is what happens if you buy and hold, the dark black line. What happens when you buy and hold at these levels for 5 years? So if I were to buy and hold starting in January of 95, and I wait 5 years, and I should have a 250% return on my investment. That's great. The best one on this time period. Couldn't ask for a better time to get involved. Conversely, or just the same thing, if I would have bought in March of 2009, 5 years later, I'd have over a 2% rate of return, a 200% rate of return. So 2 times my money. So 200% rate of return here, 250% rate of return here. Now notice though, is that whenever you buy and hold when it's red, so from 99 until 2002, 2006 to 2009, 2008, whenever unemployment is below 5% and you buy and hold for 5 years, you don't make any money because you're right on the zero line. In fact, many instances you lose money. Well, that's kind of counterintuitive, but the thing to think about is that by the time unemployment is below 5%, it means all the good news is priced in. There is really, you are priced for perfection, and this is not where you want to buy and hold the stock market. So this zero axis here is very indicative of a problem, but you'll notice wherever it's red, for the most part, you don't make any money. You're taking all this risk, buying and holding for 5 years, and you make no money. And so this chart lags 5 years, just like the other charts we looked at lag 10 years. And so over the next 5 years, this will drift this way and kind of come over here. Because again, you put your money in today, you wait 5 years, and then you get whatever return is at that time period. Point being on this chart is that when U.S. unemployment rate has been below 5%, future S&P 500 returns have been negative. Again, another way to look at the valuations, we've looked at allocation to the U.S. stock market by households. We've looked at price to sales, the Shiller price to earnings ratio, interest rates, unemployment, the toilet paper indicator. Every one of these longer term indicators are saying this is not the time period to get overly aggressive to the upside. This is the time period where you start harvesting your gains, moving into more bonds and cash, as our managers have been doing, things that pay a yield, like some of the very inexpensive real estate investment trusts they've been buying, and you're going to wait it out because this is not where you're going to make a lot of money unless you're a day trader and you know these different companies and securities cold and can jump in and jump out. This is where you just have to be very careful. So again, a indicative of what could be coming here. And then finally, one of the things I want to show you is this chart. This came out on Bloomberg, I guess about a week or two ago. It's from Nautilus Research. You can see Nautilus down here. They do some interesting stuff, and then they published it on Bloomberg. And then what they're pointing out was, sometimes the stock market doesn't repeat itself, but sometimes it rhymes, I think, to quote a famous trader from long ago. And what they wanted to show us is bottom line here. This is 2006 through 2009, 2008. And then the top one is today. And what was interesting is what they were trying to show is that, hey, you know what? Look at this. It's an eerie correlation to what we're kind of seeing here from a cyclical perspective. And in 2006, 2007, we went running up, and then we had a correction. And so same thing happened. This is 2018, had a correction. And then we chopped around, made slightly new highs in 2018. 2007 did the exact same thing. Slightly new highs, rolled over in correction. This was 2018. But 2007 did this exact same thing in the summer. And then came roaring back in the fall, made new highs. And this is October of 2007. And then it rolled over, end of the business cycle, and started a serious decline. And so here we are again. If you compare, you look at the time periods. Now the dates don't match, obviously, but the cyclicality of this, you see peak here, 2018, peak year 2007. But the time cyclicality of this, the charts look identical, well, not identical, but pretty close. You take the dates off of it and they could be mistaken for each other. So the problem is, as of May 1st, here we are right now. Right then, we're actually below this line now. So what Nautilus Research was saying is that if we are below 2875 on the S&P 500, and we are below it now, as I showed you on the very first chart, you have no business being long in the stock market because the pressure is to the downside. So if you have a large allocation to the stock market right now, you want to start harvesting gains if we are below 2875. There is no reason to be ultra long in this market at these levels because cyclically, as things happen, kind of a cyclical perspective, end of business cycle, some of these charts look very similar over time. And what this is telling us is that there's an eerie similarity here, and maybe they're wrong. They certainly could be, but you would only want to get back in the stock market if we closed above 2875 on a weekly and a monthly basis. That would give you some sort of hope that this pattern doesn't repeat, but this is a pattern recognition software, and essentially what it's saying is that given what the prior pattern has done, where we should roll over. And unfortunately, with the trade war stuff, I wish the adults were in charge of this stuff. And the president has good points, but there's now pressure to the downside. The Chinese are very adamant that they're digging in. When you read their press reports, they're saying that they can wait us out, which maybe they can, type of a thing. They're hoping for a new president to be elected in 2 years, and they got somebody else they can negotiate with. But this would tell us, though, is that historically, if we roll over and we drop, not to what we saw in 2009, but just to 2008, because remember, the bottom of the 2008 correction actually happened in March of 2009. What this pattern says, if we just have a standard correction, not our standard bear market, not the whole kind of everybody's scared to death type of a thing, that wouldn't be unreasonable to see us get to somewhere on the S&P 500 of 2,000 to 1,500. I think we get down to 2,200 is where I would expect it to happen. But the point being is that all these charts that I've shown you from the very beginning, going back to the very front, from current valuations today, here's that triple top, percentage of household wealth allocated to the stock market, the Buffett indicator, market cap to GDP, global recessionary model, the Shiller PE ratio, the price to sales ratio, the Fed raising interest rates, the toilet paper indicator, and then U.S. unemployment below 5%. None of these longer term ratios are telling us this is the time to be all in. So if you're going to be all in, which is fine, you certainly can. It's always your money. But at the end of the day, if you're going to be all in the stock market, you have to be ready for major corrections at these levels. This isn't just the 20% we saw at the fourth quarter. This is something much more sinister, where things start to unravel, where people lose faith in the dollar, where foreign countries finally start to question our country's ability to repay all the debt that we're printing. And then you see just gold blast off because gold becomes a proxy currency for everything else that's out there. Nobody really trusts the dollar. It's kind of the best of the worst. Nobody trusts the euro. Nobody trusts the yen. So what'll happen is that you'll see just gold blast off in this type of environment. So anyway, you get the point. But the idea here is I wanted you to see the current charts and where we're at today. And the thing to remember is just because we have come roaring back off of these lows in December, this pattern looks eerily similar to 2007, 2008. This is exactly what happened at that point in time. We're right at the end of a business cycle. Valuations are extreme. Again, just because your year-to-date numbers look fantastic, your numbers from January of 18 are probably anemic at best. So if you have any questions, just reach out to us. Happy to have a chat, and have the wonderful rest of your weekend. Take care, everybody. Bye-bye.